my channel. Before I start, don't forget to like, comment, share, and subscribe. I will read the article. Bob Michael, a bond market veteran for more than 4 decades, predicts a 75% chance of a US recession over the next 18 months. But thing is priced in. Clients are returning to the bond market, especially corporate bonds. Michael J.P. Morgan, asset management chief investment officer, said on Bloomberg Television. Wall Street Week on Friday. It's because they have renewed confidence in the central banks. Central banks worldwide are aggressively raising interest rates in attempt to tame stubborn inflation while trying to avoid tipping economies into recession. The European Central Bank increased rates this week for the first time in more than a decade. A Bloomberg survey of 44 economists conducted between July 15 and July 20 found expectations are that the Federal Reserve will hike 75 basis points again next week, then slow to 50 points in September. With recession expectation at 75%, Michael said the market is now fairly pricing in where they think the Fed should go, and the Fed is in sync with that. We are talking about a Fed funds rate somewhere around 3.5% at year end. The equity market, which posted its best week in a month, hasn't fully priced in a recession over the next year. Erin Brown, a multi-asset strategy portfolio manager at Pacific Investment Management CEO, told Bloomberg Television, "The market is pricing basically stagnating growth." She said, "I think it's going to be negative growth." Despite closing the week stronger, bringing this year market rose to about 17%. Stocks slid on Friday as disappointing results from social media firms and weak economy data added to recession fears. "Look, the bar was low going into earnings season," Brown said. Really what you are hearing a lot from corporates right now is that the consumer is weakening, but you are also starting to see business confidence also weaken, underscoring fears of a slowdown. Treasury extended and advance, pushing the 10-year yield to around 2.7%, while business activity deteriorated across the world in July, according to a survey from S&P Global. Persistent inflation will continue to show up in second quarter earnings, Brown said, but what's new is you are starting to see higher financing costs also start to really bite. Both agreed on the short-term outlook for Europe, saying inflation will likely remain structurally high and the European Union will continue to struggle with soaring energy costs because of Russia's war on Ukraine. The European Central Bank will do what it can to slow consumption. Throughout the ECB can only raise the rates to hike maybe 1.5 or 1.75%. That's about, Michael said. "Ultimately, we like sovereign debt there, but we like Germany," he said. "We are not necessarily sold on Italy." Brown and Michael diverged on expectation for the dollar, with retreat this week after hitting a record hike last week. Both agreed on the short-term outlook for Europe, saying inflation will likely remain structurally high and the European Union will continue to struggle with soaring energy costs because of Russia's war on Ukraine. The European Central Bank will do what it can to slow consumption, though the ECB can only raise rates so high, maybe 1.5 or 1.75%. That's about it, Michael said. Okay guys, that's all from me. Don't forget to like, comment, share and subscribe.